Chapter 1. What in the world is crypto? A crypto or cryptocurrency is a digital or virtual currency made to work as a medium of exchange. That is, it is designed to be used in buying goods and services, but uses an online ledger. Cryptocurrency uses cryptography to secure and verify transactions, as well as to control the creation of a new unit of a particular cryptocurrency. Unless specific conditions are fulfilled, cryptocurrencies as limited entries in a database cannot be changed by anyone. This is because cryptocurrencies are digital currencies based on blockchain technology. Blockchain technology will be duly explained in Chapter 2. Cryptocurrency can be used in many fields. Buying of goods. It was extremely difficult, if not impossible, to find a merchant that accepts cryptocurrency. The situation is entirely different now, as there are a lot of merchants online, and even offline, that accept cryptocurrency as a form of payment. Bitcoins can be used to pay for hotels, flights, jewelry, college degree, and any type of payment you can think of. Investment. It is believed that cryptocurrencies are the real deal investment opportunity currently available. Though cryptocurrencies are considered high-risk investment, there are still many stories of people becoming millionaires through Bitcoin investments. Their market is not steady like other assets. Moreover, there's always a risk of them getting outlawed in certain areas because they are unregulated. Also, cryptocurrency exchange is a target for hackers. To date, Bitcoin is the most recognizable digital currency, and just in 2016, one Bitcoin was valued at $800, and in November 2017, the price of one Bitcoin exceeded $7,000. If you decide on investing in cryptocurrencies, Bitcoin is easily still the dominant one, though its share in the crypto market has quite dramatically fallen, from 90% to 40%. Surprisingly, Ethereum, which is considered the second most valuable cryptocurrency, has recorded the fastest rise a digital currency ever demonstrated. Its value has increased by at least 2,700% since May 2016. Bitcoin. Bitcoin is a digital or virtual currency created in 2009 that uses peer-to-peer technology to facilitate instant payment. It is regarded as the first cryptocurrency and eliminates the need for traditional intermediaries like banks and governments to make financial transactions. In early 2009, a programmer or group of programmers under the name Satoshi Nakamoto introduced Bitcoin. Satoshi described Bitcoin to be a peer-to-peer electronic cash system, which is totally decentralized. This simply means that there are no central controlling authority or servers involved for file sharing. How's Bitcoin disrupting the global economy? Bitcoin is already transforming the global economy, while its story is just getting started. News about Bitcoin and other cryptocurrencies, as well as blockchain, is everywhere. Banks, companies, investors, and governments have taken a real interest in them. Most people now accept Bitcoin can really have an impact on the economy globally, and it is important to know how this will shape the global economy and market in the coming years. The most visible impacts will be discussed below. 1. Eliminating the need for a middleman in financial transactions. As seen in traditional currency, where intermediary is needed, it is one of the primary features of Bitcoin not to require a middleman. Rather than a bank or any central institution validating or authorizing transactions, all users of cryptocurrency verify it in a decentralized fashion. This makes transaction faster because the users do not have to pass through multiple hands for a transaction to take place. This worries the banks as this technology removes the need for their services. On an international level, there's a heightened concern as it has become harder to regulate financial activity, which of course has an interesting implication. 2. Separating transactions from the dollar. Mainstream financial transactions that take place around the world have their basis in the dollar, and this is the primary source of America's global power. This global power is what has enabled the U.S., along with some other nations of the world, to place economic sanctions on other countries. Therefore, one is right to say that the U.S. dollar serves as the reserve currency for the global economy. On the other hand, cryptocurrency transactions do not in any form have any connection to U.S. government-sponsored currency, as it completely uses blockchain technology. 3. Removing barriers to entry. The traditional routes of raising capital for business venture is to convince venture capitalists and banks to invest in your project. However, in the case of cryptocurrencies, it has enabled entrepreneurs to bypass these traditional routes. As they do not go through the venture capitalists nor banks to raise capital for crypto and blockchain-related business venture, they have the ability to bypass the regulation and red tape through an initial coin offering, or ICO. ICO is likened to public offering, whereby a company offers shares in its company for the first time. However, in an ICO, a startup sells a portion of a cryptocurrency to backers to fund a project. This has gotten so much attention, and this indicates it is disruptive. Many countries have started placing restrictions on ICOs. People's Bank of China has banned it. Securities Exchange Commission does not regulate ICOs and has issued warning about potential risk to investors considering ICOs. 4. Complicating regulation. It has been discussed earlier that one of the potential challenges related to cryptocurrency transactions is that they are hard to regulate as a result of their anonymous nature, all thanks to blockchain technology. This anonymity enables various scams. Governments are as well concerned about cryptocurrency because it makes it easy for citizens to avoid paying taxes. This development has caused various countries to consider strict regulations on crypto. 5. Enabling more international transactions. In less developed countries, around 2 billion people worldwide do not have bank accounts, and businesses still cannot accept credit card payments. For such countries, crypto offers a way to engage with the global internet economy. This has enabled many businesses in the United States to grow and survive even in times of economic meltdown. There's no denial that Bitcoin and related technologies are impacting the economy tangibly, whether we focus on the potential harm or the benefits the crypto revolution could have. There are likely many more changes expected to come as the transformation is only getting started. Bitcoin halving. Bitcoin halving is a popular term used when the block rewards for a miner start amounting to exactly half of the current block reward. Simply put, halving it as it relates to Bitcoin has to do with how many Bitcoin tokens are found in a newly created block. A block is a collection of all the transactions that are yet to be written on the blockchain. In order to explain Bitcoin halving, Bitcoin mining and block reward must be explained. What is Bitcoin mining? Bitcoin mining is the process where people use their computers to participate in Bitcoin's blockchain network as a transaction processor and validator. Miners must prove they have put effort in transaction processing in order to be rewarded. This is why Bitcoin uses a system called proof of work, POW. These efforts they put forth includes the time and energy invested in running the computer hardware and solving complex equations. Faster computers with certain types of hardware yield larger block rewards. Those who mine Bitcoins solve mathematical problems and confirm the legitimacy of a transaction. These transactions are added to a block, and chains of these blocks of transactions are created, thereby forming blockchain. When the block is filled up with transactions, the miners that processed and confirmed the transactions within the block are rewarded with what is called block reward. This block reward is Bitcoin. The block reward from Bitcoin mining used to be a whopping 50 Bitcoin when Bitcoin was starting to gain some steam. Satoshi Nakamoto, however, envisioned the concept of block halving in order to maintain scarcity. This process usually takes around 4 years after 210,000 blocks have been mined. That is to say, after every 210,000 blocks mined, or roughly every 4 years, the block reward given to Bitcoin miners for processing transactions is cut in half. Suffice it to say, the rate at which Bitcoin is released into circulation is cut in half. This system will continue until around the year 2140. Miners at this point are rewarded for processing transactions. This reward ensures that miners still have the incentive to mine and keep the network going. The idea is that competition for these fees will cause them to remain low after halvings are completed. The implication of these halvings reduce the rate at which new coins are created and thus lower the supply availability. The theory of halving and the chain reaction that it sets off works thus. Once the reward is halved, there's half inflation, which leads to lower supply and higher demand and price. Meanwhile, miners' incentive still remains, regardless of smaller rewards as the value of Bitcoin is increased in the process. In a case where halving does not increase demand and price, then there would be no incentive for miners, as the reward for completing transactions would be small, which in turn brings down the value of Bitcoin. To avoid this situation, Bitcoin has a way of changing the difficulty encountered in mining a transaction. In the event that the reward has been halved and the value of Bitcoin remained steady or did not increase, the difficulty of mining a reward would be reduced to keep miners incentivized. What does this mean? It simply means that the quantity of Bitcoin released as a reward is still smaller, but the difficulty of processing a transaction is reduced. Halving process has proven successful twice, and so far, as recorded, the result has been an incredible increase in price, outrightly followed by a large drop. However, these crashes that followed these gains still maintain prices higher than before these halving events occurred. Take, for example, the 2017-2018 bubble saw Bitcoin ballooning price around $20,000, only to drop to around $3,200. Obviously, this is an unbelievable drop, but it maintained a higher price of Bitcoin at $3,200 against the $650 before the halving. So far, so good. This system has worked, but halving is typically surrounded by immense speculation, hype, and volatility, and it is not predictable as to how the market will react to these events in the future. Each block contained 50 Bitcoin back in 2009 when Bitcoin was launched, but this amount was said to be reduced by 50% roughly every 4 years. There have been already 3 halving events since then, and a block only contains 6.25 Bitcoin. The block will only contain 3.125 Bitcoin when the next halving occurs. The first halving event occurred on November 28, 2012, after a total of 5,250,000 Bitcoin had been mined. The next followed on July 9, 2016, and the latest halving event occurred on May 11, 2020. The next event is expected to happen in the spring of 2024. Chapter 2. What is blockchain? Blockchain is simply a system that produces and stores digital information in an open ledger system in such a way that the digital information can't be hacked, deleted, changed, or manipulated without the prior permission of the owner or owners, as the case may be. Basically, in a less complex language, blockchain is literally a chain of blocks. Using the word block and chain in this context actually means talking about digital information, the block, stored in a public database, the chain. Blockchain was first used in 2008 by a person or a group of people using the name Satoshi Nakamoto. The identity of Satoshi Nakamoto remains unknown to date. Bitcoin was the first cryptocurrency to be created, and blockchain technology was used to serve as the public transaction ledger for this cryptocurrency. The invention of the blockchain for Bitcoin made it the first digital currency to solve the double spending problem without the need of a trusted authority or central server. The Bitcoin design has led to other applications of blockchain technology, putting into consideration the fact that blockchains are readily readable by the public. This one reason has made blockchain have the widest application among cryptocurrencies. There are different types of blockchain, of which at least 4 will be discussed. We have the public blockchains, private blockchains, side chains, and hybrid blockchains. Public blockchains. As the name implies, A public blockchain is a type of blockchain that have totally no access restrictions. It is absolutely available to anyone with an internet connection. As far as internet connection is available, anyone can carry out transactions on public blockchain and as well become a validator. A validator is one who participates in the execution of a consensus protocol. A consensus protocol is usually a network or networks that offers economic incentives for those who secure them and utilize some type of a proof of stake or proof of work algorithm. The largest, most known public blockchains are the Bitcoin blockchain and the Ethereum blockchain. Private blockchains. In this type of blockchain, one cannot join it unless invited or permissioned by the network administrators. This is to say that participant and validator access is restricted. In order to differentiate between open blockchains and other peer-to-peer decentralized database applications that are not open ad hoc compute clusters, the terminology distributed ledger, DLT, is normally used for private blockchains. Hybrid blockchains. A hybrid blockchain has a combination of centralized and decentralized features. The exact workings of the chain can vary depending on which portions of centralization/decentralization are used. Sidechains. This is a designation for a blockchain ledger that works in parallel to a primary blockchain. Entries from the primary blockchain, which typically represent digital assets, can be linked to and from the sidechain. This gives room for the sidechain to operate independently of the primary blockchain by, for example, using an alternate means of record keeping, alternate consensus algorithm, and so on. Applications of blockchain technology. Blockchain technology finds its application in every aspect of our lives. Experts project that it could quite literally revolutionize every aspect of our lives in coming decades. 1. Payment processing and money transfers. The fundamental use of blockchain, arguably, is as a method or means to expedite the transfer of funds from one party to another. With banks removed from the equation, and for the fact that the validation of transactions is ongoing every second, most transactions processed over blockchain can be settled within a matter of seconds. 2. Monitoring supply chains. Blockchain finds its usefulness when it comes to monitoring supply chains. It allows businesses and possibly even consumers to view and monitor the performance of products from a quality control perspective as they traveled from their place of origin to the retailer. 3. Digital voting. With blockchain technology, there will be no need to worry about voting fraud. Blockchain offers the ability to vote digitally, but it's transparent enough that any regulator would be able to see if something were changed on the network. Isn't this amazing? Simply put, blockchain technology can make your vote count truly. 4. Food safety. Another interesting use of blockchain technology could be in food tracing from the origin down to your plate. Remember, blockchain data is immutable. Therefore, one would be able to trace the transport of food products from their origin to the market. What do we gain from this? Let's say there's an outbreak of foodborne disease. Blockchain would allow the source of the contaminant to be found quicker than it can be now. 5. Tax regulation and compliance. We have been talking about immutability when it comes to blockchain technology. Transparency have also been mentioned. Any company can use blockchain as a means to record sales and demonstrate to lawmakers that they are law-abiding. These sales records, most importantly, can act as a clear record for the IRS to show that the said company is up to date with their tax, assuming they are profitable, of course. 6. Immutable data backup. Blockchain might be considered perfect for the purpose of backing data. It is unfortunate that cloud storage systems are made to be a go-to source for data safekeeping. They are not immune to hackers or even infrastructure problem. Applying blockchain as a backup source for cloud data centers or for any data whatsoever, as Boeing is considered with GPS receivers on its planes, could resolve this concern. 7. Real estate, land, and auto title transfers. It is very obvious that one of the primary goals of blockchain is to take paper out of the equation, since paper trails are often a source of confusion. What we are trying to say is that if you are buying or selling a land, a house, or a car, you will need to transfer or receive a title. Therefore, instead of handling this on paper, blockchain can store titles on its network, allowing for a transparent view of this transfer as well as presenting a crystal clear picture of legal ownership. 8. Data sharing. Recently, cryptocurrency IOTA launched a beta version of its data marketplace, demonstrating that blockchain could be used as a marketplace to share or sell unused data. Note that most enterprises' data go unused. In this case, blockchain comes handy as an intermediary to store and move this data to improve a host of industries. This is still in its early stage, but it is interesting to mention that IOTA has more than 35 brand name participants, with Microsoft being one offering it feedback. 9. Copyright and royalty protection. As a result of the growing internet access, copyright and ownership laws on music and other content has really grown hazy. Blockchain can be used to beef up copyright laws considerably for digital content download. This helps in ensuring that the artist or creator of the content being purchased gets their fair share. Blockchain would as well provide real-time and transparent royalty distribution data to musicians and content creators. Chapter 3. Litecoin and Ethereum. Litecoin. Litecoin was set up through an open source by an ex-Google engineer called Charlie Lee on October 7, 2011. Litecoin is a peer-to-peer cryptocurrency and a completely decentralized network with no central authority, with the purpose to serve digital payments faster and at a cheaper rate. Litecoin was formed from a fork of Bitcoin Core Client, and Lee referred Litecoin as Light of Bitcoin, meaning that Litecoin has some of the same characteristics as Bitcoin and, of course, few different features. The different features include the different crypto algorithms they make use of. Litecoin uses a newer algorithm known as Script 7, while Bitcoin uses SHA-256 algorithm. Litecoin is faster when compared to Bitcoin, and these characteristics made Litecoin famous. The Litecoin network transactions confirmation time is recently within 2.5 minutes, while Bitcoin's network's confirmation time is roughly 9 minutes. Therefore, Litecoin can withstand more transactions due to its small block generation time. Also, Litecoin has fixed supply of 84 million coins, and Bitcoin has just 21 million coins. With Litecoin, payments can be made to individuals in any part of the world without any middleman to monitor or regulate the transactions process. Litecoin is therefore the 9th largest cryptocurrency in market. Litecoin mining. Because Litecoin is decentralized, that is not being regulated by anybody. Litecoins are obtained through a well-known cryptocurrency method known as mining. Mining is a way of securing each block to an already existing blockchain by using a mining software. As soon as a block is secured, new units of cryptocurrency is generated and released, and that is the only time miners can put the units directly back into the market. Mining allows people to transact without any third party. Litecoin uses a model known as proof of work for mining. Litecoin trading. Litecoin is always quoted against US dollar. Therefore, when buying Litecoin as an exchange, US dollar is sold in other to buy Litecoin. A profit is made when the price of Litecoin rises. A loss will be made when a Litecoin price is down and you decide to buy it like. Factors that can affect Litecoin's price. Regulation. Cryptocurrencies are not regulated by governments or central banks. Supply. Litecoin has a fixed supply of coins available to be mined, which is 84 million coins. Availability can also rise and fall following the rate at which coins enter the market. Adoption. For now, Litecoin has not recently been adopted by businesses as a mean of transaction, but there is possibility of it being adopted in times to come. Ethereum. Ethereum is an open-source, decentralized software platform and also a programming language which runs on a blockchain and is used for its own cryptocurrency known as Ether. Ethereum helps distributed applications to work without any scam or control by the government or any other third party. Ethereum was invented in 2015 by Joe Lubin. Ether can be used mainly for two reasons, which includes, just like other cryptocurrencies, it can be traded and can also be used in Ethereum to run other applications. Ethereum was divided into two blockchains in 2006. They are Ethereum and Ethereum Classic. Ethereum has big projects, in which one of them is Microsoft's partnership with Consensus that gives eBaaS, Ethereum blockchain as a service, on Microsoft's Azure to enable clients and developers to have single-click, cloud-based blockchain developer area. When compared with Bitcoin, Ether currency is very much faster, about 15 seconds, to get than Bitcoin, about 9 or 10 minutes, and therefore making Ether to be more in circulation in the market than Bitcoin. Are Litecoin and Ethereum the only alternatives to Bitcoin? Definitely not. Thinking of a possible investment in Ethereum but not convinced? Here is what a CNN analyst had to say about the prospects of the Ether coin against Bitcoin in a recent news. Ethereum is leaving Bitcoin in the crypto dust. New York CNN Business. Hunter S. Thompson once expressed, "There isn't anything on the planet more defenseless and unreliable and debased than a man in the profundities of an ether gorge." He was alluding to the inebriating drug, not the digital money. However, Ethereum financial backers may have explanations behind dread and despising as well. The world's second most important cryptographic money has taken off considerably more than Bitcoin, XBT, in 2021 because of non-fungible symbolic craziness and expanded appropriation of Ethereum, Ether for short. Ether costs are presently drifting around 3,400 and over 350% addition this year. Bitcoin costs have risen a simple 90% via correlation. In the previous week alone, Ether is up a faltering 30%, while Bitcoin is level. That has raised a few worries that Ether has risen excessively far, too quick, very much like Bitcoin did in 2017, preceding plunging stupendously in 2018. Ethereum 27-year-old developer is presently an extremely rich person. So why has Ethereum, which currently has a consolidated market worth of nearly $400 billion for every one of its coin available for use, taken off as of late? Ether is the primary money of decision used to buy non-fungible tokens, or NFTs, the advanced resources that have gotten progressively famous in the craftsmanship and sports collectible world. For what reason is there such a lot of interest in Ether at this moment? With the blast of NFTs, individuals are seeing options to Bitcoin like Ether as a genuine utility. It's not simply a store of significant worth, the computerized gold that Bitcoin is, said John Wu, leader of Ava Labs, an Ethereum viable blockchain firm. Wu added that Ether is additionally getting a lift because of two other more specialized turns of events. Coinbase, the Goliath crypto financier firm that as of late opened up to the world, is presently supporting exchanges for Thai and US dollar coin, two supposed stable coins that are fixed to the dollar. Every one of them are viable with Ethereum computerized wallets. Ether additionally went through a hard fork, basically a move up to the Ethereum blockchain network that will help speed up. Ether, as Bitcoin, is going standard. Yet, Ether's ascent goes past specialized reasons. There is a genuine, essential, and industrious interest shift happening at the present time, said Jeff Dorman, boss speculation official at Arca, in a blog post recently. He said that up to this point, new digital currency financial backers just thought often about Bitcoin. At that point, they began to show interest in other cryptographic forms of money, especially Ethereum, as an approach to expand their possessions. Ethereum has now crossed the Rubicon into the standard, and notwithstanding the trouble of getting it, financial backers of numerous kinds are discovering motivations to add ETH to their portfolios, Dorman composed. S&P Dow Jones Files has approved cryptographic forms of money also. The file supplier behind the Dow and S&P 500 said Tuesday that it was dispatching a Bitcoin list, Ethereum record, and cryptographic money megacap list. Customary monetary business sectors and computerized resources are not, at this point, totally unrelated business sectors, said Peter Rothman, worldwide head of advancement and procedure at S&P Dow Jones Lists, in an official statement. Financial backers may be running to Ethereum just as other cryptographic forms of money on the grounds that there are rising worries about swelling approaching not too far off as the worldwide economy and U.S. work market warms up. Ether is important for the alleged decentralized money that offers monetary items which don't depend on national banks. With expansion rising, items on Ethereum are the ideal path for individuals to battle the vulnerability made by national bank cash printing and different stock stuns, said Sergey Nazarov, fellow benefactor of Chainlink, in an email to CNN Business. All that said, financial backers presumably should be cautious. Ether's ascent has been so sharp and abrupt that one can't resist the urge to expect a possible pullback like Bitcoin had in 2018 after it originally appreciated a gigantic flood. In any case, Count Greenberg, head of business improvement at Allnodes, a cryptocurrency facilitating supplier, said he's not stressed that Ether will endure a similar destiny. I don't know that Ether will plunge that much, she said. Indeed, its cost may vary. In any case, Ethereum may have considerably more potential than Bitcoin. Are Litecoin and Ether the only alternatives to Bitcoin? Far from it. Altcoins. What are altcoins? Definition and examples of altcoins. An altcoin is a cryptocurrency or virtual currency alternative to Bitcoin. Each altcoin operates according to its own rules. What are altcoins? Altcoins are alternatives to Bitcoin. They are cryptocurrencies that use a technology called blockchain that allows secure peer-to-peer transactions. Altcoins build on the success of Bitcoin by slightly changing the rules to appeal to different users. How do altcoins work? Generally speaking, altcoins work much like the original Bitcoin. Using a private key, you can send a payment from your digital wallet to another user's wallet. In a cryptocurrency such as these, there is a blockchain, or recording ledger, where the transactions are permanently and publicly recorded, so exchanges can't be altered or denied after the fact. The blockchain is secured by mathematics proofs, which confirm transactions in blocks. Altcoin versus Bitcoin. Altcoins don't all follow the same rules as Bitcoin. For example, while Bitcoin will only ever mine or produce Bitcoins every 10 minutes, an altcoin called Litecoin will produce coins every 2.5 minutes. This makes Litecoin able to process payments faster. Litecoin will also produce 84 million Litecoins, whereas Bitcoin will only produce 21 million Bitcoins. Litecoin also uses a different set of rules for mining than Bitcoin. Whereas Bitcoins require costly hardware to mine, Litecoins can be mined with common computer hardware. Litecoin is just one of thousands of altcoins on the market. Some altcoins stand out as popular alternatives to Bitcoin, although they don't reach Bitcoin's $100 billion market cap. A few examples of altcoins include Ethereum, Ripple, Dash, Litecoin, NEM, Monero 6. Pros and cons of altcoins. Pros: improve on Bitcoin's flaws, provide competition, low transaction fees. Cons: value is very volatile, high potential for scams and fraud. Pros explained: improve on Bitcoin's flaws. Altcoins are generally designed to address a perceived shortcoming with the Bitcoin framework, whether it's speed, mining cost, or some other factor. Provide competition. By tweaking the rules under which Bitcoin operates, altcoin creators make space for new competitors to the Bitcoin system. Low transaction fees. One of the benefits of using altcoins as a payment method, in addition to secure blockchain technology, is the relatively low transaction fees charged for each transaction. Cons explained. Value is very volatile. As an investment, altcoins are very new, and their value can change drastically. High potential for scams and fraud. Altcoins, as with Bitcoin, are frequently the subject of scams and other fraudulent schemes. Types of altcoins. Altcoins are sometimes projects from enthusiasts, and sometimes the basis for whole new businesses. They can even be more than coins, developing into entire new frameworks for everything from messaging applications to online marketplaces. An altcoin will often change Bitcoin's rules sufficiently to do something uniquely productive and may have a particular application. Some coins, such as Solar Coin, have been designed as a unit of exchange for solar power production. Others, such as Namecoin, have formed the basis for a new system of domain names on the internet. Consider these different types of altcoins. Stablecoins. Stablecoins are altcoins that are designed to combat the volatility of cryptocurrency by tying their value to an underlying index, commodity, or security. Tether is one example of a stablecoin. Libra is a stablecoin under development by Facebook. Digital tokens. Altcoins that function as digital tokens are supported by an underlying blockchain platform. For example, Tether can also be considered a digital token, as it is built on Ethereum and other blockchains. Some investors seek to earn returns by exchanging altcoins with each other, too, but as an investment, it's risky. Virtual currencies trade on unregulated exchanges, which leave you vulnerable to price manipulation, fraud, and other problems. Key takeaways. Altcoins are alternatives to Bitcoin. Altcoins are a form of digital currency or cryptocurrency, each with its own set of rules. Altcoins are very new, and their prices can be very volatile. Chapter 4: Trading Cryptocurrency. As discussed earlier, Bitcoin became the first ever cryptocurrency in 2009 when it was released. It was difficult and almost impossible to trade it as that was the only coin available. It was few years later, when more and more cryptocurrencies were created, that people started trading them. The idea is as simple as trading one cryptocurrency for another with the hope that the coin you buy increases in value. Many investors like to trade cryptocurrency because it's an extremely volatile asset. If the market is timed right, cryptocurrency trading can give you much higher returns than our familiar traditional investments. Cryptocurrency traders often have one or two goals: to accumulate cryptocurrency, most especially Bitcoin, or to make a profit in US dollars. Cryptocurrency trading involves speculating on price movements or buying and selling the underlying coins through an exchange. Cryptocurrency market is decentralized, which means they are neither regulated nor backed by any central authority, such as government or a body. They instead run on a technology that uses networks of computers. That being said, cryptocurrencies can be bought and sold through exchanges and stored in what is known as wallets. Cryptocurrencies only can be found as shared digital record of ownership stored on a blockchain. If there's a transaction to occur, a user sends cryptocurrency to another user's digital wallet. This transaction is only considered a final unit when it has been verified and added to the blockchain through a process called mining. The exchange market. A cryptocurrency exchange, or a digital currency exchange, is a platform built to allow users to buy and sell cryptocurrencies or digital currencies for other assets such as conventional fiat money or other digital currencies. There are numerous crypto markets, but it is pertinent to note that they all have the same steps in carrying out their transactions and also the same setup. Things are not done differently in different platforms. The only difference can come in coin listing, which means that no exchange market listed all the cryptocurrencies that exist. This goes further to explain that you may find a particular cryptocurrency in one market, but may not find it in another. Therefore, this shows that the crypto exchange market to use is primarily dependent on the cryptocurrency you want to buy or sell. Below are good and reliable crypto exchange markets. 1. Coinbase. This is the world's largest crypto exchange available in the United States of America, Canada, and the majority of the countries in Europe. It offers several payment options. Binance. This is the second largest exchange that buys and sells over 130 different currencies and has low transaction fees at about 0.1%. 3. BitMEX. BitMEX is the third largest exchange and strictly trades on Bitcoin. It is great for short selling and margin trades. 4. Bitrex. This is a US-based exchange founded by the ex-Microsoft security professionals. 5. Robinhood. This exchange is new and takes no trading fee. It has about 6 million users. 6. OKEX. OKEX is a Hong Kong-based exchange that trades over 145 different cryptocurrencies. 7. GDAX. This is a US-based exchange that allows users to trade Bitcoin, Ethereum, Litecoin, and other cryptocurrencies. 8. itBit. This operates as both global over-the-counter trading desk and a global Bitcoin exchange platform. 9. CoinMama. CoinMama allows you to buy and sell easily. It accepts cards and has a large global outreach. Day trading. As the name implies, Day trading is the type of trading that happens during and within the day only. This simply means that you would have to acquire and sell the assets for profit, of course, within a day. This is also known as intraday trading. This type of trading helps the trader to focus on small movement of value, unlike what is seen in long-term trading. Through practice, one can finesse the skill required for this trading through constant practice. Day trading cryptocurrency is almost similar to traditional day trading. However, it happens in crypto ecosystem. A trader can easily trade crypto assets at any point in time because the business hours don't restrict your actions. Note that you may want to pay corresponding network and transaction fees, so it becomes very important that you chose a compatible cryptocurrency trading platform. Factors to consider while day trading. Liquidity. In the case of day trading, liquidity refers to how easily a trader can sell the stock and make profit in return. Simply put, if the stock is easily sellable, it is very liquid. If otherwise, the stock is not very liquid. Volatility. Volatility refers to the frequency and size of an asset's price. An asset is considered very volatile if the value changes frequently. If, on the other hand, it retains its value for an extended period of time, then it is considered non-volatile. Popular day trading strategies. Scalping. This plan helps the trader sell the stocks as quickly as possible, as the style focuses on the small price changes of an asset in the market. As a day trader, you must have the right access to live information from the market, else it will be impossible to employ this strategy. Range trading. To employ this trading strategy, the trader should properly understand candlestick charts and momentum indicators to get the best results from range trading, as this requires the trader to define a price in the market structure. This trade only takes place within this range, and the trader needs to constantly continue the process until the asset is out of range. High-frequency trading. This is the type of trading that uses algorithms. Traders who use this style will develop algorithms and trading bots to watch the market and trade assets. This proposes an increased profit chance since the transaction occurs within seconds. It is important to note that building algorithms and trading bots need coding knowledge and market expertise. One of the most frequent questions asked is if one can make a living by day trading cryptocurrency. Anyone can absolutely make a living by day trading cryptocurrency. However, you have to spend more time watching the market activity because of the volatility of crypto assets. Unlike the traditional stocks, crypto assets can have a price change in minutes or even few seconds. Short-term crypto trading. Short-term trading is one of the most common trading approaches used in the market today. This is popular with Forex and stock market, but has gained extreme popularity with crypto traders as well. Short-term trading is also known as active or aggressive trading and is based on the short-term price movements. The most popular short-term approach is day trading, in which all trading are opened and closed within 24 hours. The high volatility of cryptocurrencies has presented many trading opportunities that arise same day, and there are a few short-term trading strategies used by crypto traders. Below are short-term crypto trading strategies. Daily support/resistance levels. As a result of the narrow time frame of short-term trading, traders aim for small to moderate profits. This strategy is one of the most popular strategies for short-term traders. Short-term traders in this case would perform technical analysis based on 20 MA, an hourly chat, and then draw horizontal diagonal trend lines connecting the previous highs and lows. For example, there could be an imminent breakout if the price action is trapped within a symmetrical triangle. Applying the 20 MA, a convergence with the triangle resistance level creates a resistance block. Remember, the aim is for a moderate gain. The previous resistance block, triangle resistance plus MA, is now seen as the invalidation level. Anything close at or below this level will close the trade. Hammer pattern. This has proved to be one of the most effective short-term strategies. The pattern, as the name implies, is based on a candle that looks like a hammer. This strategy occurs in a bearish market. The formation of the hammer candle suggests the market is trying to create at least a short-term bottom. The second candle that follows the hammer candle should be a strong bullish candle, also pointing towards a market reversal. This pattern offers clearly defined levels to a crypto trader, as any move below the low of a hammer candle is seen as an invalidation zone. The take gain can be calculated based on the R to R ratio preferred by a trader. Trend lines. The trend line trading strategy is one of the basic strategies a crypto trader can use in short-term trading. In this case, the trader is expected to watch closely in order to identify trend lines connecting at least 3 consecutive lows or highs. Take, for example, you are looking at a trading pair which is moving slightly higher on the M30 time frame. If the price descends any time, it in turn finds a support at the trend line and bounces higher. This is an opportunity for a crypto trader who would then wait for a potential fourth touch, which will be used to open the trade. The stop should be located beyond the third bounce swing. Similarly to the hammer pattern, R to R ratio will determine the gain. Advantages of short-term trading. Unlike fiat currency markets, where prices usually don't move by more than 1% each day, cryptocurrency prices can almost double overnight. Short-term trading offers a good opportunity to make high percentage profit. Disadvantages. The prices can change very quickly due to the volatility of the market. Therefore, to embark on short-term trading, the trader needs to spend a lot of time analyzing the markets. This is the ability to read trading graphs and charts, which can take a lot of time to learn if you are a beginner. Long-term cryptocurrency trading. Long-term trade simply means purchasing of assets with the expectation of selling at a higher price in the future to make profit. While short-term traders aim at small or moderate gain, long-term traders have an unlimited profit potential since the price of an asset can rise indefinitely. The simple idea is that even though there will be volatility, the price is expected to increase in a large amount over the long term. A great example of long-term trading is the investors who bought Bitcoin in 2011 at 35 cents. In 2017, the price ballooned to almost $20,000 and will fetch the investors huge profit if they held on to it. Advantages. One of the main advantages is that it's easy and does not require a lot of time, as the case in short-term crypto trading. No need for ambiguous charts or graphs. You can buy small amounts whenever you have some spare money and then let it grow over a long period of time. This gives you less stress of market volatility, as there's absence of worry over short-term movement and price. Disadvantages. A long-term trader might miss a good opportunity to make a quick short-term profit, as sometimes coins rise in value quickly, only to fall straight back down. Only short-term traders grab these opportunities. Long-term traders are not spending time studying charts and graphs, and could miss news about the value of the asset. Chapter 5. How to become a successful trader. A crypto trader is simply an individual who seeks profits from differential changes in the market price of cryptocurrencies. The main objective to buy cryptocurrency at low price and sell at high price to make profit. Crypto trading can be lucrative and has thus become one of the fastest growing careers in the financial spectrum. To become a successful trader, one must follow the steps discussed below. Self-control and discipline. It is okay to say that trading is not for everyone. If you do not have self-discipline, it will be almost impossible for you to achieve one's trading goal. Cryptocurrency market is very volatile compared to what traditional market is, hence more risk and reward. Risk management. There's a relationship between reward and risk management, and a successful cryptocurrency trader must be able to understand this relationship. From closer studying to constant practice, a successful cryptocurrency trader is expected to understand when it's best to trade as market conditions change from time to time. As a result of crypto market volatility, risk management must not be ignored as your profits can be zapped away in seconds. It is pertinent to do your own research in the crypto space and rely less on market sentiment, as risk can come from lots of scam projects with good marketing teams. Timing. Every successful cryptocurrency trader is expected to know the best timing to trade in order to make profits. Basic fundamental and technical analysis skills. Either rumors or news have exponential effects on the crypto market and often create lucrative trading opportunities. Therefore, every successful cryptocurrency trader must keep track of all fundamentals going around the cryptocurrency community, because any piece of information tends to determine the market price of cryptocurrencies. Beginner mistakes. Trading cryptocurrencies involves activities that include hard work to make profit from trading process. Therefore, it is very essential to develop specific qualities necessary for achieving high competence, analytical mind, and attentiveness. Many people rush into cryptocurrency market with very small effort, hoping to have a breakthrough, but reality hits them and makes its adjustment. A beginner soon enough may become disappointed with this kind of activity. Top beginners' mistakes will be discussed below. 1. Unwillingness to study the situation on your own. Beginners soon lose a lot of money because they refuse to study or learn the crypto market carefully with an expert, and also fail to make thorough researches on their own. If you fail to understand the product and its value, but only listen to so-called experts on various social media, then you will get into trouble. Bottom line is exploring the market in which you work. 2. Investing the money. You cannot afford to lose. Note that not a single person is insured against failures, as even top experts experience financial losses. A characteristic feature of acquiring practical knowledge is making mistakes and learning from it. This is a volatile market, and risk is highly involved. Putting all your savings or even loans into the market is just not advisable. 3. Allowing emotions, excitement, and unconfirmed information affect your decision-making. It is okay to admit that avoiding mistakes can be difficult, especially when you follow news from World of Cryptocurrency on Twitter. The most patient ones still wins, as it is not easy to follow everything at once. Let there be elements of truth in those news, and have patience. 4. Sales at peak prices. In cryptocurrency market, no one ever knows how much a particular token will grow. For successful cryptocurrency trading, you need a strategy. No matter what, set a goal and strive to achieve or attain this goal. Don't panic and sell everything at once. 5. Buying cheap coins. This is a common mistake among beginners. It is not advisable to invest money in currency just because they are cheap. Most novices are used to thinking, that most of the altcoins with a low price are just underestimated because there are already many stories of sudden growth in value. This is not so, as not all of the cryptocurrencies are profitable. 6. Security. This is considered the most serious beginner's mistake. This can even happen to experienced traders. Scammers are everywhere, with the development of technology especially, where there is insufficient control. If you do not want to stay in the trade for so long, a careful approach to security of your data is expected of you. Use two-factor authentication, individual computers, data encryption to tighten your security. Make physical copies of data. Write down all passwords, secret keys, print and put away in a very safe place. 7. Fear of missing out, FOMO. This manifests itself in situations where one tries to sell all of an asset at an early stage due to the fear of losing profits. It might be difficult to get rid of FOMO, but you can fight it in order to become a successful cryptocurrency trader. To fight this, create a plan, strategies, and rules for trading. Most importantly, note that new opportunities appear every time in the world of cryptocurrencies, so relax and let this fear melt away. Trading Guide. Many investors like to trade cryptocurrency because it's an extremely volatile asset. If you can time the market right, trading crypto can give you much higher returns than traditional investments. Cryptocurrency traders often have one of two goals: to accumulate Bitcoin or make a profit in US dollars. In a crypto bull market, it's pretty easy for your portfolio to increase in US dollar value, but it's more challenging for Bitcoin value to increase. To track your portfolio's Bitcoin value, you can trade altcoins against Bitcoin on exchanges like Coinbase Pro. By actively trading your cryptocurrency, you risk losing your crypto to the market. Since cryptocurrency prices are so volatile, it's not uncommon for traders to lose money quickly trading cryptocurrencies. This is why so many crypto enthusiasts just hodl their Bitcoin. Understanding cryptocurrencies. For the sake of emphasis, and to ensure you understand what crypto really is, let's try to drive this point home once more. Although there are many different types of cryptocurrencies, they all have one thing in common. They operate on blockchain technology, making them decentralized. Decentralization of financial operations through cryptocurrencies has several efficiencies over the traditional financial system, including cuts out almost all the overhead costs associated with banks, less expensive transactions that can be sent and received internationally, inflation or finite supply that's written into code, no need to trust the Federal Reserve. Financial derivatives like trading strategies and loans can be coded directly onto certain cryptocurrency blockchains, replacing the need for financial intermediaries. The largest cryptocurrency is Bitcoin, and it's used as a digital gold. Essentially, Bitcoin is a commodity used as a store of value. Ethereum is the second largest cryptocurrency, with a market cap of $210 billion. Developers can develop smart contracts on Ethereum's blockchain to create decentralized alternatives to traditional banking functions like lending and trading. Selecting a cryptocurrency. There is no single best cryptocurrency, but there are best cryptocurrencies for certain use cases. For example, Bitcoin is the best cryptocurrency to use as a reserve asset because it has the most widespread adoption and a finite supply. Most of the best cryptocurrency projects are in the top 50 market capitalization of cryptocurrency. Most small market capped cryptocurrencies have questionable use cases or have underdelivered on their promises. Small market cap cryptos are generally riskier than large market cap coins like Bitcoin and Ethereum. It's important to invest in cryptocurrencies that have a solid team backing the project. To get information about a cryptocurrency, it's best to read the cryptocurrency's white paper. This will give you an idea of how the crypto works and what its intended use is. Decentralized finance, DeFi, cryptocurrencies are some of the hottest altcoins of 2021. Altcoins are a general term for any cryptocurrency other than Bitcoin. DeFi tokens are typically built on Ethereum's blockchain and replace traditional banking functions with code. Popular DeFi tokens like Yearn Finance, Compound, and Uniswap are up over 500% in the past 6 months. Here are the top 5 DeFi tokens, ranked by market capitalization. Uniswap, Aave, Synthetics, Maker, Solana. Non-DeFi altcoins have also seen a significant increase in value over the past year. Ethereum, the largest altcoin by market cap, has risen from $90 to over $1,800 in less than 1 year. Ethereum has gained a lot of interest due to the variety of financial applications being built on its blockchain. Bitcoin, BTC, $54,618, down 4.17%. Ethereum, ETH, $3,361.11, up 1.77%. Binance Coin, BNB, $626.36, down 6.03%. Dogecoin, DOGE, 53 cents, up 22.5%. XRP, $1.46, down 5.64%. Coinimage, Tether, USDT, $1, down 0.03%. Coinimage, Cardano, ADA, $1.31, down 2.48%. Coinimage, Polkadot, DOT, $35.79, down 2.97%. Coinimage, Uniswap, UNI, $43.53, up 3.99%. Coinimage, Litecoin, LTC, $312.77, up 7.74%. How does cryptocurrency work? Cryptocurrencies are digital assets that are powered on the blockchain. Blockchain technology stores a ledger of every transaction of the cryptocurrency on every node powering the blockchain. Nodes are computers that are connected to Bitcoin's network to mine Bitcoin. If one of these miners tries to enter false transaction, it will be nullified by the correct ledger. The correct ledger is determined by the majority of miners' records. In theory, you could hack a blockchain by controlling 51% of the cryptocurrency's network in a process called a 51% attack. However, this process is economically infeasible and would require an extremely choreographed hack with billions, if not trillions of dollars worth of computer hardware. To transact with a cryptocurrency, you need to have a set of public and private keys. These keys are like passwords generated by your cryptocurrency wallet. Your public key is connected to your wallet's address and allows people to send you cryptocurrency. Your private key is used to approve transactions being sent from your wallet. Only you have access to your private keys. Contrary to popular belief, many cryptocurrencies don't have a finite supply. Bitcoin's total supply is capped at 21 million coins, but many altcoins have a set inflation rate with no cap on total supply, like Ethereum. Pros and cons of investing in cryptocurrencies. Investors are attracted to cryptocurrency due to its high volatility. It's not uncommon for a cryptocurrency's price to fluctuate over 10% in a single day. This is great if you're looking for high returns, but if you're a risk-averse investor, then investing in cryptocurrency may not be for you. Cryptocurrency trading steps. Take a look at the 5 steps to trading cryptocurrency. Step 1. Create a cryptocurrency brokerage account. Unless you already own cryptocurrency, you'll need to create an account with a crypto brokerage. Coinbase, Gemini, and eToro are among the best crypto brokerages on the market. All 3 of these options offer a simple user interface and a variety of altcoins to choose from. To create an account, you'll need to provide your crypto brokerage with personal identification information, similarly to opening an account with a stock brokerage. Some common information you need to provide when setting up your account includes your social security number, address, date of birth, and email address. Step 2. Fund your account. Once you've signed up with a crypto brokerage, you'll need to connect your bank account. Most crypto brokerages offer bank funding through debit cards and wire transfers. Wire transfer is typically your cheapest option to fund your account. It's free on Coinbase and Gemini. Step 3. Pick a crypto to invest in. Most active cryptocurrency traders allocate most of their capital to Bitcoin and Ethereum. These cryptos move more predictably than smaller altcoins, so trading with technical indicators can be easier. Many crypto traders allocate a portion of their capital to smaller altcoins. Although small mid-market cap cryptos are riskier than large market cap cryptos, they offer higher upside potential. Many small altcoins have risen over 1,000% in a matter of months, making them attractive investments for risk-tolerant investors. Step 4. Choose a strategy. There is a plethora of trading indicators to choose from, and most traders take multiple factors into consideration when buying and selling cryptocurrency. If you're new to investing, you may want to consider purchasing a cryptocurrency trading course. If you're an experienced trader, you may already have a strategy you use to trade stocks. Stock trading strategies are also commonly used for cryptocurrencies. A personal favorite trading strategy that many traders use is Elliott wave theory. Elliott wave theory focuses on the psychology behind the market sentiment, so it works particularly well for speculative assets like cryptocurrencies. Step 5. Store your cryptocurrency. If you're actively trading cryptocurrency, you'll have to store your funds on the exchange to have access to them. If you're buying your cryptocurrency to hold for the mid to long term, then you should get a cryptocurrency wallet. Cryptocurrency wallets come as software wallets or hardware wallets. Both are secure, but hardware wallets offer the best security as they store your crypto on a physical device, offline. Ledger is a great hardware wallet brand many investors trust to store their crypto assets on. If you're looking for a software wallet, there are several options on iOS, Google Chrome, and Android that are free to use. Best cryptocurrency brokers. There are a ton of options when it comes to cryptocurrency brokerages. For new investors, Coinbase is a great option. Coinbase has a free cryptocurrency conversion feature where you can trade your crypto for any other token supported by Coinbase. Other crypto brokerages that are solid options for intermediate traders are eToro, Binance, and Gemini. Robinhood also supports certain cryptos, but the platform only supports trading for 5 altcoins. Cryptocurrency trading versus stock trading. Cryptocurrency trading is often seen as more high risk than stock trading, but it depends what stocks or cryptocurrency you're trading and how you're trading it. Trading penny stocks or trading options can be equally, if not more, risky than trading cryptocurrency. Before trading cryptocurrency, you should be aware that you risk losing your money to the market. If you really believe in the future of cryptocurrency, holding your crypto assets for the long term may be more beneficial than trying to time the markets. Frequently asked questions. What was the first cryptocurrency? The first cryptocurrency was Bitcoin, which was created by an anonymous figure named Satoshi Nakamoto in 2009. Is cryptocurrency real money? Cryptocurrency is a digital asset class of its own. Some cryptocurrency can be used as money, but others are used for identity, governance, data storage, and much more. Can I invest $100 in Bitcoin? If you have $100 in your bank account, you can buy $100 worth of Bitcoin. Bitcoins can be split up to its 8th decimal place. The smallest unit of measurement for Bitcoin is called a Satoshi, and it's 1/100 millionth of one Bitcoin. Market analysis strategies. There are a wide assortment of venture and exchanging procedures that you can utilize with regards to digital currency, from hodling it to day exchanging. In the event that you will likely make a benefit, however, just something important truly matters. Purchase low and sell high. This is, obviously, actually quite difficult. In the event that it wasn't, we'd all be rich. Recognizing when the lows and highs will come is especially hard, and doing as such with any level of sureness is incomprehensible. Nobody can genuinely anticipate what's to come. In any case, there are sure techniques for market examination that crypto brokers and financial backers ordinarily use in their dynamic cycles to give them a superior thought of when to enter and leave their situations. At the end of the day, to purchase and sell. The two generally basic of these are specialized investigation and essential examination. Both have their impediments, yet utilized in the correct way, they can help you improve educated exchanges. Specialized investigations. Specialized investigation is based on the reason that set of experiences rehashes the same thing. It's centered fundamentally around authentic market information, like exchanging volume and past valuing patterns, instead of what a coin or task really does. Investigation of this information is utilized to fabricate a clearer image of market notion by distinguishing examples of rehash practices. This would then be able to assist you with making determined forecasts about when the market will be bearish, moving down, or bullish, moving up. These forecasts ought to, in principle, permit you to purchase when the market cost is low and offer when it's high to make a benefit. This technique for examination basically accepts that value developments aren't arbitrary and that previous examples will hold later on. Albeit quite a few variables might have impacted the cost of a coin to move a particular way, in specialized investigation, you truly take a gander at market interest and the cost of a coin. After a pattern is shaped by a coin, specialized examinations types accept that it's most likely going to follow that pattern to go against it. In this way, if the market is bullish for a significant measure of time, requests will decrease the inventory of coins available to be purchased and the cost will increment. As the cost goes up, you can anticipate that it should get bearish sooner or later as individuals attempt to underwrite by selling their coins. As they sell, supply starts to exceed request, making the cost go down. Also, the cycle proceeds. Does it work? Eventually, specialized examination is such an expansive order that it can't be said to just work or not work. Its prosperity relies generally upon the individual doing the investigation. It is not necessarily the case that it essentially must be confounded and you must be a numerical virtuoso, yet it is not difficult to confuse and you need to understand what you're doing. Whenever utilized accurately, this strategy can positively shape a mainstay of your point of view, and there are some that depend on it. Similarly, you can't foresee the future basically by taking a gander at the past. There are numerous variables to consider. Master specialized experts once in a while depend on it in separation. They'll likewise search for setting. Basic investigation. Basic investigation is a more 10,000-foot view approach than specialized examination. It takes a stab at a careful assessment of a resource's natural worth, considering whatever number of subjective and quantitative factors as would be prudent. On the off chance that you judge the characteristic worth to be lower than its present market value, you can exchange as needs be and, in principle, make a benefit. Similarly, on the off chance that you accept the resource for be exaggerated, you can really exchange to make a benefit when resources decline in cost. This is known as shorting. Basic investigation isn't selective to digital currency. It's entirely expected to a wide range of exchanging. Be that as it may, it requires an alternate methodology. Cryptographic forms of money are not enterprises. They don't have public budget summaries. This makes it difficult for dealers to determine an exact valuation for Bitcoin from future incomes in the manner you can for different resources. A digital money's reasonability relies upon different components to check its latent capacity and the current strength of the local area in the organization. There are future possibilities and remarkable highlights to consider. With Bitcoin, you would find out if it will work as a mechanism of trade and what separates it from cash. For instance, Bitcoin's complete stockpile is fixed at 21 million units. It's hence in its very own extraordinary class among monetary forms. In contrast to fiat money, which a national bank can print voluntarily, Bitcoin has a fixed and unsurprising all-out supply volume. You likewise take a gander at things like exchange volume and client movement to measure buyer interest, just as retail selection. Bitcoin has gained moderate yet consistent headway toward mass appropriation as a mechanism of trade. Today, it has been embraced as an installment technique by a huge number of organizations and internet business stages around the world. In key examination, this may assist you with understanding whether it is playing out its planned capacity through your eyes. At long last, worldwide monetary occasions can apply an amazing impact on digital money costs. It's imperative to consolidate these monetary movements when utilizing essential examination and an exchanging procedure. This incorporates both planned and unscheduled occasions. An exceptionally exposed and significant crypto-related occasion, like the dividing, for instance, obviously affects the future stockpile pace of the money. You can get ready for this and join it into your models. Similarly, an unscheduled occasion could have a much more noteworthy effect. For instance, an administration's choice to liberate Bitcoin. This is clearly harder to consider, yet you actually need to realize how to react to such spontaneous occasions if and when they happen. Does it work? There are some that contend the cost of advanced resources effectively join the entirety of the unique information focuses that might actually influence their cost. This basically delivers any further endeavor to survey the market excess. Besides, similarly as with any resource, it's difficult to precisely anticipate request, and there will consistently be a component of possibility. Major examination is essentially worried about an advanced resource's theoretical worth, as opposed to its real worth at some random point on schedule. Notwithstanding, information is power. By utilizing the bits of knowledge conveyed by central examination, Bitcoin brokers and financial backers can acquire a more profound comprehension of the inborn cost of the money. This could eventually help them in settling on more educated and productive exchanging choices. Which is appropriate for you? Specialized examination is planned more for momentary exchanging. This is on the grounds that the course amendments it searches for can occur inside the space of days, if not hours. Notwithstanding, it is additionally utilized for direction on broad long-haul up and descending patterns. The fundamental slip-up that you could make when they are beginning is depending too vigorously on specialized techniques. Indeed, even its greatest fans recognize that it's far-fetched that you will be effective utilizing it in disengagement. You need other data and setting. Similarly, principal examination isn't amazing either and will regularly reflect what a security ought to be worth, rather than what its real market cost is. Most dealers focus on a contextualized and adjusted utilization of basic investigation and specialized examination, in a nuanced, insightful interaction which additionally considers essentials just as other data, for example, request stream information and shrewd cache cooperation. At last, it's down to you to sort out what this resembles. This interaction will be directed by your own conditions and will frequently be experimentation. In the event that you do choose to take up exchanging, try to be mindful during this stage and never put away more cash than you can stand to lose. One reality stays valid for any exchanging procedure. The convenience a strategy for investigation has relies upon how you use it. Do your own examination and depend on data from reliable sources. In the realm of advanced cash, information is power, so the more you know, the more effective you will be. Proven trading strategies. When trading cryptocurrencies, trading styles abound, and you will experience a few famous exchanging styles. You may likewise find that your prosperity utilizing one procedure won't reflect another person's prosperity. At last, it's dependent upon you to choose which the best exchanging system is. Some significant variables to consider incorporate your character type, way of life, and accessible assets. In this article, we go through 6 of the most widely recognized exchanging systems that could move you to test new exchanging methods or even develop your current exchanging methodology. Figure out how to begin exchanging on our cutting-edge stage. 1. News exchanging technique. A news exchanging technique includes exchanging dependent on news and market assumptions, both previously and following news discharges. Exchanging on news declarations can require a gifted mentality, as news can travel rapidly on computerized media. Brokers should survey the news following it's delivered and make a fast judgment on the best way to exchange it. Some key contemplations include: is the news as of now completely calculated into the cost of an instrument or just halfway valued in? Does the news coordinate with market assumptions? Understanding these distinctions in market assumptions is urgent to progress when utilizing a news exchanging technique. News exchanging methodology tips. Treat each market and news discharge as an individual substance. Create exchanging techniques for explicit news discharges. Market assumptions and market responses can be much more significant than news discharges. For additional inside and out tips, read our article about exchanging news delivers here, which covers different variables that are mainstream with standard brokers. When exchanging dependent on news delivers, it's essential that the broker knows about how markets work. Markets need energy to move, and this comes from data stream, for example, news discharges. In this way, usually news is now considered into the resource's cost. This outcomes from merchants endeavoring to foresee the consequences of future news declarations and thusly the market's reaction. It's smarter to make a trip than to show up. The above is a typical exchanging adage. This adage proposes that it very well may be smarter to exchange on value activity before a declaration instead of essentially sitting tight for the declaration. Doing so may shield the broker from the unpredictability that can follow a supposed declaration. Advantages of information exchanging. A characterize section and leave technique. Entering and leaving an exchange depends on how the market deciphers the news, which is normally laid out in a merchant's arrangement. Many exchange openings. Consistently, there are a few news occasions and monetary deliveries that can give exchanging openings. You can follow essential news declarations by observing our financial schedule. Downsides of information exchanging. Overnight danger. Contingent upon the sort of information, exchanging positions might be open more than a few days. Any places that are left open for the time being cause for the time being hazard. News exchanging requires master abilities. News dealers need to see what certain declarations will mean for their positions and the more extensive monetary market. Also, they should have the option to comprehend news from a market point of view and not just emotionally. 2. End-of-day exchanging technique. The finish-of-day exchanging technique includes exchanging close to the end of business sectors. End of informal investors become dynamic when it turns out to be certain that the cost is going to settle or close. This methodology requires the concentrating of value activity in contrast with the earlier day's value developments. End of informal investors would then be able to hypothesize how the cost could move dependent on the value activity and settle on any markers that they are utilizing in their framework. Brokers ought to make a bunch of hazards the board orders, including a breaking point request, a stop misfortune request, and a take benefit request to lessen any for the time being hazard. This way of exchanging requires less time responsibility than other exchanging systems. This is on the grounds that there is just a need to examine outlines at their opening and shutting times. Advantages to end-of-day exchanging. It's reasonable for most merchants. End-of-day exchanging can be a decent method to begin exchanging, as there is no compelling reason to enter various positions. Less time responsibility. Merchants can dissect outlines and submit marker requests either in the first part of the day or around evening time, so it very well may be essentially less tedious in contrast with different systems. Disadvantages of end-of-day exchanging. Overnight danger. Overnight positions can cause more dangers. However, this can be alleviated on the off chance that you put in a stop misfortune request. Insured stop misfortunes are considerably more valuable to moderate dangers. 3. Swing exchanging technique. The term swing exchanging alludes to exchanging the two sides on the developments of any monetary market. Swing brokers intend to purchase a security when they presume that the market will rise. Else, they can sell a resource when they speculate that the cost will fall. Swing merchants exploit the market's motions as the value swings to and fro, from an overbought to oversold state. Swing exchanging is absolutely a specialized way to deal with investigating markets, accomplished through considering outlines and breaking down the individual developments that contain a greater picture pattern. Fruitful swing exchanging depends on the translation of the length and term of each swing, as these characterize significant help and obstruction levels. Moreover, swing dealers should recognize patterns where the business sectors experience expanding levels of supply or interest. Brokers additionally consider if force is expanding or diminishing inside each swing, while at the same time checking exchanges. Swing exchanging technique tips. During solid patterns, it's feasible to utilize retracement swings to enter toward the pattern. These focuses are likewise alluded to as pullbacks or plunges in a current pattern. At the point when another energy high is made, brokers will look to the most elevated likelihood exchange, which is normally to purchase the primary pullback. Be that as it may, when another energy low is made, merchants will in general hope to sell the main convention. Utilize our example acknowledgement scanner to recognize graph designs as a component of specialized examination. Peruse our article on techniques for swing exchanging stocks to help manage your own procedure. Swing exchanging can offer a decent danger-reward proportion if an arrangement is followed. In any case, swing merchants should be adaptable and should know about when their system isn't working adequately. Advantages of swing exchanging. It's suitable as a leisure activity. Swing exchanging can be more reasonable for individuals with restricted time in contrast with other exchanging procedures. Be that as it may, it requires some exploration to see how wavering examples work. Many exchange openings. Swing exchanging includes exchanging the two sides of the market, so dealers can go along and short across various protections. Downsides of swing exchanging. Overnight danger. A few exchanges will be held for the time being, bringing about extra dangers. Yet this can be alleviated by putting in a stop misfortune request on your positions. It requires adequate exploration. A ton of exploration is needed to see how to examine markets, as specialized investigation is contained a wide assortment of specialized pointers and examples. Open a live record. Open our full scope of items and exchanging apparatuses with a live record. 4. Day exchanging technique. Day exchanging, or intraday exchanging, is appropriate for merchants that might want to effectively exchange the daytime, for the most part as a full-time calling. Informal investors exploit value variances in the middle of the market open and close hours. Informal investors regularly stand firm on various footholds open in a day, yet don't leave positions open for the time being to limit the danger of overnight market unpredictability. It's suggested that informal investors followed a coordinated exchanging plan that can rapidly adjust to quick market developments. Not long before the open of the FTSE and other European business sectors, merchants should hope to examine the help and obstruction levels and the potential responses to the earlier evening's exchanging the U.S., just as moves that have happened in the Far Eastern business sectors. Numerous dealers hope to exchange the European business sectors in the initial 2 hours when there is high liquidity. Something else, dealers generally center between 12 p.m. to 5 p.m. GMT when both the UK and US markets are open. Advantages of day exchanging. There is no for the time being hazard. By definition, Intraday exchanging requires no exchange is left open for the time being. Restricted intraday hazard. An informal investor just opens transient exchanges that typically last around 1 to 4 hours, which limits the probability of dangers that may exist in longer-term exchanges. Time-adaptable exchanging. Day exchanging may suit individuals who want adaptability with their exchanging. An informal investor may enter 1 to 5 situations during the day and close every one of them when targets are hit or when they are halted out. Various exchange openings. An informal investor can utilize neighborhood and worldwide business sectors and can open and close numerous situations inside the day. Downsides of day exchanging. It requires discipline. Like other momentary styles, intraday exchanging requires discipline. Brokers ought to use a pre-decided technique, complete with passage and leave levels, to deal with their danger. Level exchanges. This is the point at which a few positions don't move inside the day, which is normal. 5. Pattern exchanging technique. This technique depicts when a broker uses specialized investigation to characterize a pattern and just enters exchanges the course of the pre-decided pattern. The pattern is your companion. The above is a popular exchanging witticism and perhaps the most precise in the business sectors. Following the pattern is not the same as being bullish or bearish. Pattern dealers don't have a fixed perspective on where the market should go or in which bearing. Accomplishment in pattern exchanging can be characterized by having an exact framework to first and foremost decide and afterward follow patterns. In any case, it's critical to remain ready and versatile as the pattern can rapidly change. Chapter 6. Risk Management. Risks refer to the likelihood of an adverse occasion occurring in your exercises, an occasion that goes in opposition to your expected result. Hazard is an integral part of the digital currency exchange. It is the opportunity of an undesired result on the exchange, which means making misfortunes. For example, a half danger on a short position just implies that there is a half likelihood that the Bitcoin cost will rise, bringing about a misfortune on your part. Today, we take you through the straightforward standards to follow when overseeing hazard in crypto exchanging. Kinds of hazards. The crypto exchanging world is presented to 4 principal sorts of monetary dangers. Credit hazard. This danger influences crypto projects. It is the likelihood of the gatherings behind the crypto project neglecting to satisfy their due commitments. Credit hazard is generally ascribed to robbery and misrepresentation in the crypto market. A genuine model is the hacking of Binance in 2018, which prompted more than $40 million misfortune. Legal hazard. Legal hazard alludes to the likelihood of an adverse occasion happening concerning administrative standards. For example, a prohibition on digital money exchanging a particular country. A down-to-earth illustration of lawful danger is the point at which the territories of Texas and North Carolina gave a restraining request to BitConnect digital money trade because of doubt of misrepresentation. Liquidity hazard. Liquidity hazard, in regard to crypto exchanging, alludes to the opportunity of a dealer being not able or crippled to change their whole situation over to fiat monetary forms, US dollar, yen, Great British pound, that they can use in their consistently spending. Market hazard. Market hazard alludes to the opportunity of coin costs going up or down in opposition to your craving in a vacant position. Operational hazard. Operational hazard is the opportunity that a broker can't exchange, store, or even pull out cash in their crypto wallets. Primary danger, the board systems. The dependable guideline in crypto exchanging is, don't chance beyond what you can bear to lose. Given the gravity of hazard in crypto exchanging, we by and large encourage brokers to utilize not over 10% of their spending plan or month-to-month income. Additionally, exchanging with acquired cash isn't prudent as it places them in a credit hazard position. Hazard the board techniques can be comprehensively classified into three: hazard reward proportion, position measuring, just as stop misfortune and take benefits. 1. Position estimating. Position estimating directs the number of coins or badge of digital money a broker will purchase. The likelihood of acknowledging extraordinary benefits in crypto exchanging entices brokers to contribute 30%, half or even 100% of their exchanging capital. In any case, this is a problematic move that puts you at genuine monetary dangers. The brilliant standard is, never tied up your assets in one place. Here are 3 different ways to accomplish position estimating. Enter sum versus hazard sum. This methodology thinks about 2 unique sums. The first includes cash you will put resources into each and every arrangement. We encourage merchants to view at this sum as the size of each new request they take, paying little heed to its sort. The second implies cash in danger. For example, the cash that you remain to lose on the off chance that the exchanging comes up short. This is the way you characterize your enter sum. A equals stack size times hazard per exchange divided by section costs minus stop misfortune times passage cost. Suppose we wish to buy Bitcoin with USDT with an objective of $13,000. Our boundaries would be stack size $5,000, hazard per exchange 2%, passage cost $11,500, stop misfortune $10,500. Our enter sum would be A equals 5,000 times 0.02 divided by 11,500 minus 10,500 times 11,500 equals 1,150. The ideal adds up to put resources into this arrangement is 1,150 or 23%. Nonetheless, because of our stop misfortune, we just danger 2%, as it will stop the exchange once it arrives at the decided level. Hazard exchanging cryptographic money. Seniors, sharks, and piranhas. This idea of position estimating identifies with expanding your ventures. Dr. Alexander Sr., who is credited with this idea, recommends 2 standards. Restricting each position to 2% danger. Senior thinks about hazard to a shark chomp. Now and then you would wish to hazard a tremendous sum. However, the danger would be enormous and calamitous as a shark nibble. Restricting exchanging meetings to 6% per meeting. In a losing streak, you may wind up spending all that you own gradually. Senior thinks about this danger to a piranha assault, which takes little chomps of its casualty until it burns through everything. Following Senior's sharks and piranhas approach brings about close to 3 open positions for every 2% each, or 6 ones for each 1%. Restricting outcomes in turn around compounding. Misfortunes get more modest and more modest with each ensuing misfortune you make. Kelly standard. The Kelly basis is an equation created by John Larry Kelly in 1956. It is a position measuring approach that characterizes the level of cash flow to wager. It suits long-haul exchanging. A equals achievement percentage divided by misfortune proportion at stop misfortune minus 1 minus achievement percentage divided by benefit proportion at take benefit. Utilizing the pass model, the highlights would be stock size $5,000, contributed sum $1,150, achievement percentage 60%, passage cost $11,500, stop misfortune $10,500, misfortune proportion 1.1, take benefits $13,000. Our outcome would be A equals 0.6 divided by 1.10 minus 1 minus 0.06 divided by 1.13 equals 0.19. This implies you ought not danger over 19% of the whole capital of $5,000 for you to show up at the most ideal result in a progression of arrangements. 2. Hazard-award proportion. The danger-reward proportion contrasts the genuine degree of hazard and the likely returns. In exchanging, the more hazardous a position, the more productive it can get. Understanding the danger-reward proportion empowers you to realize when to enter an exchange and when it is unfruitful. The danger-reward proportion is determined as follows. R equals target cost minus section cost divided by passage cost minus stop misfortune. From the past outline, section cost equals $11,500, stop misfortune $10,500, target cost $13,000. Our proportion would be R equals 13,000 minus 11,500 divided by 11,500 minus 10,500 equals 1.5 or 1 to 1.5. A proportion of 1 to 1.5 is acceptable. We exhort merchants not to exchange with a proportion lower than 1 to 1. 3. Stop misfortune and take benefit. Stop misfortune alludes to an executable request which shuts a vacant position when a value diminishes to a particular hindrance. Take benefit, then again, is an executable request that sells open requests when the costs ascend to a specific level. Both are acceptable ways to deal with overseeing hazard. Prevent misfortunes save you from exchanging unrewarding arrangements, while remove benefits let you get from the exchange before the market can betray you. You can utilize following stop misfortunes and take benefits which follow the rate's progressions consequently. Such a component, in any case, isn't accessible at most of crypto's trades. Luckily, with crypto terminals like Superorder, you can set your following stop misfortunes and take benefits directly from the terminal. Winning systems. Acknowledge disappointments. Hazard is a vital part of exchanging. Plus, we can't dispense with it, however, just oversee it. You ought to, in this manner, acknowledge your misfortunes and depend on arrangement-based dynamic to acknowledge benefits in future exchanges. Think about expenses. New merchants frequently don't have a clue about the expenses that join exchanging. Such incorporate withdrawal expenses, influence charges, and so on. You ought to consider these in your Danger the Executives. Zero in on the success rate. Dangers will consistently be there to deter you from exchanging. Be that as it may, zeroing in on the occasions you win assists with building up an inspirational perspective in exchanging. Measure drawdown. This alludes to the absolute decrease of your underlying assets after a progression of misfortunes. For example, in the event that you lost $1,000 from $5,000, your action drawdown is 10%. The higher the sum, the more you would have to infuse into an exchange for it to recuperate. As Dr. Senior exhorted, adhere to a 6% danger limit. Security measures. Putting resources into and exchanging digital currencies has gotten increasingly more famous for the most part because of accounts of individuals who got back twofold or even triple the sum they put in. These accounts are, in fact, valid. Take, for instance, of Whirlpool Zillan, who put a couple $1,000s in crypto and turned into a mogul. Obviously, individuals need to have a similar achievement, actually like Swirl. Nothing unexpected then that the crypto market acquired 17 million confirmed clients in 2018. There are numerous chances to acquire benefits in the crypto market. However, there are likewise tricks and other security gives that have tormented the business throughout the long term. In 2019, Bitrue, a Singapore-based crypto trade stage, was hacked for around 4.2 million worth of digital money resources. One phishing trick that continued for a very long time, beginning in 2016, deceived numerous financial backers, and supposedly more than $100 million in digital money was taken. While there are still a lot of individuals who need to attempt their hand exchanging crypto, there are some who are reluctant essentially on the grounds that they are terrified. Presently, how would you be able to deal with, abstain from succumbing to tricks, and trading off the security of your records? Tips to help you secure your digital currency. 1. Continuously check your record action. Have you at any point made a review of all your cryptographic money wallets, logins, and different records that contain data identified with your crypto resources? Assuming you haven't done that, you're putting your records in danger. To begin, browse your email inbox so you can see which crypto stages you pursued. You can compose these on a piece of paper or track it in a spot that you believe is generally secure for you. Realizing every one of your records will help you screen the exercises and act quickly ought to there be something dubious going on. It's basic, however helpful. 2. Check if an underlying coin offering, ICO, is phony. While contributing and exchanging are various creatures, ICOs cross into a broker area since promoting is aimed at individuals with a little crypto experience. It's enticing to put resources into an ICO that guarantees incredible innovation and high return for money invested. Yet, this is the place where numerous new kids on the block merchants and financial backers get defrauded. In the event that you don't have the foggiest idea about the warnings, odds are you'll become part of the insights. There are a few things you can do to distinguish these phony ICOs. Check the site's colleagues. Search for any data about the authors and their staff. Research their exercises via online media accounts. In the event that you see that their number of preferences and adherents they gathered doesn't coordinate with their record movement, at that point that is a warning. Peruse their white paper. Check on the off chance that it contains dependable assets, a sound guide for execution, and a well-informed monetary model. Request tests or code transfer to storehouses like GitHub. Assuming they can't deliver it, it demonstrates that no genuine undertaking or blockchain improvement is going on. You can recruit an engineer online to look at it on the off chance that you don't have the right stuff yourself. Ensure that the ICO engineers have set up an authentic escrow administration to get speculations. Be careful about the individuals who are getting assets through an individual digital currency wallet. It's generally simple to set up an ICO, which is the reason tricks have ascended throughout the long term. The U.S. Protections and Trade Commission, USEC, even made a phony ICO to give financial backers the obvious indications of a false ICO. At the point when an offer appears to be excessively acceptable, burrow around for more data prior to taking an action. On the off chance that you are feeling FOMO through the advertising and insufficient substance, leave. 3. Utilize two-factor validation, 2FA, and confine your programming interface keys. Two-factor confirmation helps add a layer of safety to your record. In any case, it is profoundly encouraged to not utilize the SMS 2FA, as it very well may be captured. Maybe CryptoFans recommends the Google Authenticator application, since it tends to be utilized disconnected and it is nearby to your gadget. Assuming you're utilizing an outsider programming to help your exchanges, you should put limitations on your programming interface keys, so it will just work with explicit IP addresses. That way, you're guaranteed nobody will actually want to contact your record regardless of whether they figure out how to track down your mysterious keys. 4. Try not to succumb to a phishing email. Programmers these days are more intelligent with regards to phishing for data. That is the reason you should be extra cautious at whatever point you get messages with outer connections. Customarily, these phishing messages are intended to resemble an authentic organization and might be interesting to distinguish. Prior to clicking any outside connection or giving individual data, check the area name. Real organizations utilize their space name to send messages. Programmers will in general utilize area names that look practically like the organization. For instance, an email with the area @coinbase.org might be effortlessly confused with @coinbase.com. Additionally, if the email requests that you affirm individual data, be careful. Quest for the association and reach them straightforwardly. Try not to utilize any type of correspondence showed in the email. Be dubious also of any connection in the email, as it could be a malware. This is generally utilized by con artists to get into a PC and take data. In conclusion, don't send digital money to a wallet through email. ICOs and crypto trade stages will not request that you move crypto utilizing this strategy. 5. Try not to store the entirety of your cash in a trade. Throughout the long term, some crypto trades have become casualties of hacking assaults and other security issues. This brought about a significant number of their client accounts being frozen or, more awful, traded off. That is the reason there is no assurance that your tokens can be securely put away in a crypto trade stage. It ought to be put away in a private wallet. There are 4 unique kinds of wallets: paper wallet, hot wallet, portable wallets, and cold wallets. In the crypto world, it is strongly prescribed to have a chilly wallet, otherwise called an equipment wallet. It has a protected component, SE chip, to get your keys in a disconnected gadget. Since it is disconnected, your data is less helpless against likely hacks. In addition, the chip installed in the gadget remains disconnected in any event when associated with the web. This implies that regardless of whether the PC has malware, your private keys will not be undermined. A portion of the equipment wallets you should consider are Record Nano S, Trezor 1, KeepKey. Side note: it's totally typical for brokers to leave their exchanging assets on the trade for accommodation. It saves sending it all advances and in reverse every day. In the event that you are content with the danger, take the plunge. However, eliminate your benefits consistently and keep those disconnected so you are just gambling a sum you can confront losing. 6. Use programming to shroud your advanced impression. An advanced impression relates to every one of the hints of your online movement. This incorporates your online media posts, remarks, tweets, IP address, and login subtleties. Programmers can utilize these follows to get to your own data. You don't need this to occur and hazard trading off the security of your crypto resources. That is the reason it is prescribed to utilize a virtual private organization, VPN, to conceal your character while perusing and get your online exercises far from inquisitive eyes. This is not difficult to do. All you need is to download a legitimate VPN program, introduce it on your gadget, and run it. With this, you're making yourself considerably more undetectable on the internet, encoding your information and concealing your IP address. Digital money security keeps on developing. Security in the digital money world isn't just the duty of the clients, yet in addition, specialist organizations also. Luckily, throughout the long term, advancements across blockchain innovation have permitted digital money specialist organizations to venture up with regards to client security. As of late, the Ethereum network saw a $5.2 million expense charged to a trade. After some examination, it was speculated that this was an extortion endeavor. The programmers had the option to get to the trade's assets, yet they couldn't move any of it away as a result of the numerous safety efforts set up. By and large, account security is a two-way road where the client needs to take prudent steps and for the product organization to fix all weaknesses in their framework. Simply remember that dissimilar to ordinary banks/reserve funds in Europe, you are not insured to get some cash back if there is a hack or other misrepresentation. The brilliant guideline. Essentially, don't be credulous. It's 2020 and programmers are substantially more complex, regardless of whether they live in their mom's storm cellar. So don't make it simple for them. At the point when you take off from your home, you likely don't leave the entryways opened. The equivalent goes for your monetary resources. Basic strides to take, for example, keeping your crypto in a cool wallet, leaving just your exchanging balance on the trade, and routinely doing account reviews will help you become safer in the realm of crypto exchanging. Digital wallets. Finally, it seems individuals have gotten used to the possibility of computerized wallets. Regardless of whether this is on the grounds that they're mindful of how secure, quick, and helpful they are, the portable computerized wallet industry is required to blast. We can thank the accompanying best computerized wallets of 2020 for driving the charge forward. 1. Money Application. Money Application was delivered in 2014 and permits clients to make contactless purchases with their iPhone or iPad, just with the iPhone 6 or more current. This advanced wallet stores your credit and check card data in the same way as other computerized wallets. Nonetheless, this data is changed over into tokens that can just be gotten to with your finger impression. All in all, it's quite possibly the most secure wallets accessible. Money Application, additionally, has another item fittingly called Wallet. This helpful application stores everything from tickets, show and film tickets, steadfastness cards, and coupons. 2. Due. When Due dispatched in 2015, it zeroed in on giving an imaginative invoicing and time following answer for consultants and private companies. The organization has now immediately extended to bring to the table a safe advanced wallet alongside e-payment, e-bank, and installment preparing capacities. Due additionally comes furnished with project the executives and the customer the board abilities. Basically, Do has become a total answer for organizations, all things considered. Do charges a level 2.8% for every exchange expense, regardless of where you reside on the planet. There are no secret charges or overcharges. 3. Google Wallet. Up until 2016, Google Wallet was a versatile application. It's currently a web application that permits you to send cash to anybody in the US by utilizing only an email address or telephone number straightforwardly from your check card, ledger, or wallet equilibrium. Moves happen in only a few minutes, and you'll require your Google Installments PIN to get to reserves. 4. Android Pay. Android Pay is Google's protected and quick in-store cell phone installment alternative that is incorporated directly into the working framework. Like most other versatile wallets, Android Pay depends on NFC innovation to empower installments by tapping a telephone to an NFC-empowered terminal. Makes Android Pay engaging that Walgreens has dispatched a dedication program for Android Pay clients, and you would now be able to request and pay for food through Grubhub. 5. Samsung Pay. Dispatched in 2015, Samsung Pay accomplishes something that no other advanced wallet does. It uses both NFC and MST innovations. This implies that you can make contactless installments at NFC-empowered terminals and conventional attractive Stripe terminals. Other than having the option to store your credit and check cards, you can likewise store gift vouchers, rewards cards, and participations. Samsung even has its own award framework for buys. 6. PayPal. PayPal is one of the most established and most generally utilized computerized wallets. It's been utilized to make installments on the web and move assets between different gatherings without any difficulty. PayPal is accessible for both Android and iOS clients. PayPal has ventured up its game in the wake of consenting to arrangements with MasterCard and card processor First Information. This permits clients to have the alternative of paying with the PayPal application, which is a similar interaction as tap-to-pay choices like Apple Pay or swiping a PayPal MasterCard to make buys coming up. 7. Venmo. Discussing PayPal, the organization additionally claims Venmo, which is ostensibly the most famous shared installment applications out there. Basically, connect a Visa, charge card, or financial records and begin repaying your companions. You can likewise get installments as well. Venmo utilizes information encryption to ensure your monetary data, and you can even impart your exchanges to a message on Facebook, Twitter, or Foursquare. Bank and check card move are free. However, card expenses are 2.9%. 8. Alipay. As a piece of the Goliath Alibaba, it's nothing unexpected that this is China's driving outsider installment arrangement and computerized wallet. In 2016, however, Alipay moved past terrain China and showed up in Europe, basically for Chinese travelers to make in-store installments and get offers. For organizations arranged in a city that is a well-known traveler objective, or assuming your business has an online store that obliges abroad clients, it's very worth checking Alipay out. 9. Walmart Pay. Delivered throughout the mid-year of 2016, Walmart's portable wallet utilizes QR codes instead of tap-to-pay that depends on NFC innovation. This wallet is viable with Android and Apple telephones and can likewise be utilized to sort out Walmart gift vouchers, make shopping records, store your Walmart receipts, reorder your remedies, and even discover a things area inside your favorite store. 10. Dwolla. Dwolla gives an advanced installment network that can move cash between U.S. financial balances and credit associations basically by utilizing their email address or a telephone number. There's additionally a computerized wallet highlight to store individual and installment data so exchanges can happen inside a day. This makes sending and getting installments, paying workers, setting up repeating installments / charging a breeze. There are no exchange charges, and with Dwolla's natural programming interface, you can tailor fit the program so it accommodates your particular requirements. 11. Vodafone M-Pesa. M-Pesa is a portable installment stage that is essentially utilized in Africa, especially in Kenya, and can be utilized by iOS and Android clients. The portable help permits clients to put cash on stores and pull out the assets, move cash to different clients, take care of bills, and buy versatile administrator administrations. Exchange expenses between unregistered clients cost around 101 to 500 Kenyan shillings, which is equivalent to $1 to $5 and 27 Kenyan shillings for enrolled. Hard wallets. Best Bitcoin hardware wallet in 2021. Trezor Model T, a cutting-edge hardware wallet, $179 at Amazon. Trezor One, simplified version of the Trezor Model T, $59 at Amazon. Ledger Nano S, everything is protected by a PIN code. CoinKite Cold Card, for those who want high security. Billfold Steel Bitcoin Wallet, fireproof, waterproof, shockproof, and hackerproof. Conclusion. Cryptocurrency is no doubt the new gold mine, but you have to do thorough researches before investing your money in its trades, as the volatility of the market can make you lose your capital in a single day. But when you know the rules and follow the signals, you can make killer profits. Introduction. We live in a world where everyone wants to get ahead financially, and the crypto revolution has offered many the opportunity to make something out of their financial lives. However, not everyone who dreams of achieving financial freedom through cryptocurrency investments succeeds. This necessitated the creation of this book to help the ordinary investor out there with all the vital information needed to succeed in the crypto world. In this book, you will learn what cryptocurrency is, the different cryptos available for investment, platforms for trading, mistakes to avoid, trading strategies to adopt, and a whole lot more. Sit back as we take you on a ride through the crypto world.